Okay, so today we would be taking our last part of the FR portion, that is interpretation of FS. Okay, so
Okay.
here mainly what we study is the ratio equation and how to interpret the ratios according to the FS that is given in the question. Okay,
Okay.
so ratios are divided into four categories. Okay,
Mm-hmm.
profitability ratios, liquidity ratios, long-term financial stability ratios, and investor ratios. The ratios have also been revised according to IFRS 18 as well. Okay.
Okay.
Okay. So on the basis of performance, we are basically looking into the revenue first. So any ratios under profitability would be compared against the revenue because revenue is the key performance indicator of a business. Clear?
Mm-hmm.
Okay. So first ratio, gross profit margin ratio. We're going to take gross profit divided by sales revenue into 100. That's all. Okay. That
Okay.
percentage would give you the gross profit margin ratio. Clear?
Mm-hmm.
Okay. So suppose if the gross profit hasn't increased in line with the revenue, then what does it mean? It might mean that under gross profit, what are the factors that are there? There is inventory, there is purchase, right? There is
Mm-hmm.
opening inventory, purchase, and closing inventory, right?
Yeah.
Okay. So an increased purchase cost might make the profit low uh even if you can earn revenue, right?
Mm-hmm.
So gross profit, if it's low and if the revenue is constant throughout the time means there is something wrong with the COS involved. Understood?
Understood.
Clear? Same way,
Clear.
inventory write-offs could be there, or any other cost which is allocated to cost of sales might increase, right? So
Mm-hmm.
increase and decrease in gross profit is directly linked with revenue or cost of sales. Clear?
Clear.
Okay, next is operating profit ratio. This is operating profit divided by sales revenue. So under the new IFRS 18, we have the revenue, cost of sales, gross profit, and then the operating expenses, and then comes the operating profit, right? So that is the
Okay.
operating profit that you're supposed to take it here. Clear?
Okay. Clear.
Understood?
Yes.
Okay. So operating profit margin would tell you the differences in the differences that has happened in the profit making capacity in terms of cost of sales, gross profit, all the operating expenses, etc. Okay. So if
Mm-hmm.
something is increasing or decreasing, it is probably due to those contents before operating profit is derived. Understood?
Understood.
So it could be the
Mm-hmm.
changes in administrative and distributive distribution expenses. It could be changes in the gross profit that has incurred in the current year. Clear?
Mm-hmm.
Understood, no?
Understood.
Next is ROCE, that is return on capital employed. Okay. So this
Mm-hmm.
is earlier it used to be on PBIT, profit before interest and tax. Now it is on operating profit. Clear? So it is
Clear.
operating profit divided by capital employed into 100.
Mm-hmm.
Understood? Okay.
Understood.
So operating profit, either in the question, if you have operating profit, you can take it. Otherwise, you can take operating profit before financing and income taxes. That is PBIT itself. Clear?
Clear.
Understood, no? So what is the
Yes.
capital employed? See, capital employed is basically the capital that the business has. So business has funds from two main sources. One is the equity, one is the debt. So capital employed is basically equity plus debt. Understood?
Understood.
Okay. Now, ROCE is often not just ROCE, any ratio for that matter is always compared to the previous year. And then we are comparing it with the current year. Clear?
Clear.
Okay. Now, similar to ROCE, there is something called return on equity. Okay. So, return on equity is calculated as profit after taxes divided by equity into 100 percentage. Understood?
Mm-hmm.
Clear?
Clear.
Okay. In this case, we could also take pre-tax profit as well if the need be. Okay.
Okay.
Now, how does a return on capital increase or ROCE increase or decrease if the in case of previous year's figure, provided there have been no changes in the accounting policy, or is there or no adjustment have been made? So in these cases, ROCE is going to be constant. Clear?
Yeah.
Okay. Now,
Mm-hmm.
if suppose the non-current asset is not replaced, okay, and
Okay.
due to that, their value is going to keep on decreasing, right? In
Mm-hmm.
this case, ROCE will increase. Understood? It's just you when you talk about ROCE, you have to vaguely be present in mind the simplest form of the SOFP. That is, in SOFP, total assets is going to be equal to total liabilities. That right?
Mm-hmm.
Okay. So
Yeah.
often when you are in the question, when you are attending the question, there might be like the equation would be mixed up. That is, in the equation, there could be total assets given and a current liability would also be given. So how do you take the capital employed from this particular item? And the current asset would also be given. You're going to remove everything that is not part of the capital employed. Understood?
Understood.
Okay. You understood that?
Somewhat. So basically, you're saying only.
We know that total asset is equal to total equity and liability, right?
Mm-hmm.
This much you know. You can see this,
Yeah.
right?
Yes, I can.
This much you know, right?
Mm-hmm.
Okay, so if in the question they have given you current asset and current liability, clear? Okay, so what you basically do is from these particular amount, the total assets amount is given to you. So you're just going to deduct the current asset and current liability from the total assets amount to derive the equity and liability. Sorry,
Makes
you're
sense.
just going to remove current liability with total equity and liability amount in order to get the capital employed. Otherwise, in order to get a total asset amount, in this way, you can cross check and make different equations out of it. Understood?
Understood.
Clear now?
Yeah, I understand. Okay.
Now, also, ROCE basically measures that is how much of the operating profit is there in comparison to the amount that is invested into the business. That is the main thing. Clear?
Mm-hmm.
Next is net asset turnover ratio. So net asset turnover ratio basically measures in terms of the fund invested, how much does the business create sales. Understood? And this
Understood.
particular amount is represented in times. It's not a percentage. Okay. So when you get the answer, it is over the times. Clear?
Okay.
Okay. So if the higher, if there is higher asset, net asset turnover ratio means the all the funds are used very efficiently, creating more and more sales, right?
Mm-hmm.
Understood.
Yeah, understood.
Okay. Now, in the
Mhm.
same way, you could also take a non-current asset turnover. Okay. That is, instead of taking capital employed, here you're going to take non-current asset instead. Clear?
Okay, clear.
Also, they could be also working capital turnover ratio. Clear? In
Mm-hmm.
this area, instead of capital employed, you're going to take the net current assets. Understood? Net
Okay,
current asset
understood.
as in current asset minus current liabilities.
Mm-hmm.
Clear? Now, the
Yes.
relationship between the three ratios, that is profit margin, asset turnover, and ROCE is like this. Operating profit divided by sales revenue, that is operating profit margin into sales asset turnover gives you ROCE. Clear?
Clear.
Understood, no?
Mm-hmm. Yeah.
Okay, so
So
operating
we're
profit
basically
margin,
combining it's the other ratios that we just learned to get the ROCE.
yeah, ROCE.
Yeah, okay.
This is another equations of ROCE. That's all they're trying to say. Clear?
Okay.
So if you
Yes.
cancel this and this, what is left? Tell me. Operating profit by
Come
capital.
again, sales revenue and sales revenue. We have operating profit over capital employed, which is ROCE.
Yeah. See?
Yeah.
Now, position analysis as in the working capital ratios. So working capital ratios, we're going to start from current ratio. So current ratio is basically comparing two of them, that is current asset with current liability. Under this, we have, that is under working capital ratio, we have two kinds of ratios, current ratio and quick ratio. Current ratio is what we have just explained. Clear?
Mm-hmm.
And it is always represented in terms of is to 1. Clear?
Clear.
So even if you get a decimal point 2.5, we say 2.5 is to 1. Understood?
Mm-hmm.
Clear?
Clear.
Now, in this case, current asset and current liability should be in within a limited range. It shouldn't be too high, it shouldn't be too low. Clear?
Mm-hmm.
So high levels of inventory ratios means high levels of current ratio means there's too much inventory kept in the warehouse, or there's too much trade receivables which hasn't been converted, so it is bad. Clear?
Mm-hmm.
Understood? No?
Yes. When you say high or low, are we comparing the number based on prior period? And
Yes.
then if our ratio is higher or lower in comparison to this is where I know. Like this, basically comparing it to the prior period is the indicator.
Yeah, indicator. That means
Okay.
it shouldn't be too high. Current asset should be a minimal. That is 2 is to 1, 2.5 is to 1 is okay.
Okay.
Okay. So
Yeah.
what the ideal ratio is that it is 2 is to 1. Okay. Appropriate for all the businesses. But most recently, they have found out that it is 1.5 is to 1 is ideal. Clear?
Mm-hmm.
Okay. It is good that the business has few inventories left, few trade receivables left. Clear?
Clear.
But instead, the others must be opposite. That means it should have more trade payables. That is, trade payables which could be manageable. Understood?
Mm-hmm.
So in the end, it shouldn't be too high. It shouldn't be too low. That's all. Clear?
Okay. Clear.
Now, quick ratio is when you're going to take only those current assets which is readily available or which could be readily converted into cash. Clear?
Clear.
So this consists of mainly cash and receivables and other current investments. Understood?
Mm-hmm.
That means the current assets excluding inventory and excluding the prepaid expenses, you get the quick assets. And quick assets divided by current liability is the quick ratio. Understood?
Okay, understood.
It is also known as liquidity or asset test ratio. Clear? This
Mm-hmm.
basically measures how much of the liquid cash that the business might hold in case of emergency or something. Basically, how
Okay.
much the company has in their hands, cash and cash equivalents, or something that could be converted quickly into cash and cash equivalents. Clear?
Clear.
Okay. Next is inventory holding period. So inventory holding period is inventory divided by COS into 365 days. So this basically tells us how many days the inventory has been held in the warehouse. Okay.
Okay.
So if it is high, it is bad because the inventory might go into obsolescence, right?
Mm-hmm. Okay.
Or it could be ruined, or it could be damaged as long as it is kept in the inventory. Understood?
Understood.
So lower the amount, great is the business. Clear?
Clear.
Now, another alternative ratio in order to express this particular inventory holding period is cost of sales divided by inventory and in times. Clear?
Okay. Wait, what does times again? Times PA mean?
Times is just a number. That means if you
Oh,
calculate
okay, that means equals.
five,
Okay, okay.
yeah, 5, then you're going to say 5 times, not 5% or 5 days, nothing like that.
Okay.
Just measured in
Fine.
times. It's a
Okay.
unit measure.
Okay.
Clear?
Clear.
Okay, so if it is increasing, what would we say? That the demand of the goods is less, hence inventory is staying there, right? Or
Mm-hmm.
we can say that the company is having a poor inventory control, or we can say that there is much more increase in cost because the inventory held us for too long that we have to repair the damage that is done due to obsolescence, right?
Mm-hmm.
So all
Okay.
of these things. Okay, now.
Okay.
The inventory holding period, if it is increasing too much, it might not be that bad if, only if that amount of inventory is being sold at larger quantities. Understood?
Understood.
Okay. So larger the inventory, the holding period goes high, right? But it
Mm-hmm.
mustn't be bad in case of wholesale businesses because everything goes by bulk. Clear? So there is no chance of obsolescence because everything goes all at once. Understood?
Understood.
Okay. And sometimes businesses great in booming, right? Is surging their sales such that they have to have more inventory in their stock. So that is also fine.
Okay.
Clear?
Clear.
Next is receivable collection period, and this is measured for knowing how long does it take in order to convert your receivables into cash. Clear? So
Clear.
equation is trade receivables divided by credit sales into 365.
Okay.
Clear?
Clear.
Right? Now, if this is going two-way, this is going too high, that means the business is not doing well because they are not efficient enough in collecting their trade receivables. That is what it means. So if trade receivables are not collected, then that means they would have working capital problems as well. Understood?
Understood.
Okay.
Mm-hmm.
Now, suppose in the question, if you don't have a credit sales separately given, you're just going to use the sales. That's all. Clear?
Okay. Clear.
Okay. So
Mm-hmm.
inventory collection period, when it is high, it is bad. It is due to that. It might be that, okay, the receivables are there for long. Okay. There could be irrecoverable debts coming on the way, right? Because
Mm-hmm.
receivables are not moving. Understood?
Understood.
But there are also counter advices or counter comments given to that as well. That means it might be a deliberate policy so that you can attract more trade. Okay, that means you need to have that customer come back to you often, so you're giving them much more time than usual. Clear?
Mm-hmm.
Okay. Now there might be a major new customer. Okay, and you have given them a separate terms as compared to others that you give. Okay. So
Okay.
those kinds of reasoning could be there. Clear? Next
Clear.
is the payables payment period. That is trade payables divided by credit purchases into 365 days. This measures how many days a business takes in order to pay back their trade payables. Clear?
Mm-hmm.
Now, in case in the question, credit purchase is not given, you're going to take the COS or the purchase alone. Clear?
In case trade payables wasn't there.
No, no. Credit
Oh,
purchases
credit purchase. Okay.
you're going to take COS or any
Okay.
total purchases. Clear?
Okay. Fine. Clear.
Or if total purchase is given and cash purchase is given, you're going to deduct cash purchase from total purchases in order to get the credit purchase. Clear?
Okay. Okay.
Okay. Now, so in business, it is considered that you need to get a long credit payables period. Clear?
Mm-hmm.
But it mustn't be too long. Okay. Because if it takes too long, then the chances are we are going to lose the trade discounts that the creditors would give us. The discount in settlement. Understood?
Understood.
Okay. So if the trade payables is too long, the company might lose its reputation because everyone would view us the same way, right? They are
Mm-hmm.
buying things and they don't pay much often, right? So it creates
Yeah.
that image. Clear?
Clear.
Okay. Now, if the existing suppliers are not happy with our payment frequency, they might discontinue giving us the goods, right?
Yeah.
Okay. And also, as I said, there could be much higher discounts when we pay easily, right? So when we hold out, we might lose those discounts. Understood?
Understood.
Okay. Now, working capital cycle, that is the cash cycle. And this is basically inventory turnover period plus receivable collection period minus payable payment period. Understood?
Understood.
Basically, asset minus liability. Clear?
Mm-hmm. Clear.
Now, long term financial stability. So, this actually looks towards how a company is going to perform in a long term basis. These all that we have just discussed is a short term thing. Clear? So,
Okay.
first one, gearing ratio. So, gearing basically is related with the financing part of the business. Clear?
Mm-hmm.
Okay. And there could be high gearing and the low gearing, right? So, highly geared business means it has a very big portion of funds coming from fixed capital, okay, or it has higher amount of loans that is being borrowed. Understood?
Understood.
Low geared business means the funds in comparison is basically low. Okay. Now, if
Mm-hmm.
it is a low geared business, then the chances are the company would have still remaining in their hands the chance to raise funds again through borrowings. Understood?
Understood.
Clear?
Yeah.
Now, how do you measure gearing? The first one is debt equity ratio. Okay, debt equity ratio is basically debt divided by equity. Okay, and in
Mm-hmm.
case of debt, what all debts do you have? You have the long term borrowings that you choose to take. You have the preference share capital because it comes under debt. Okay,
Mm-hmm.
divided by equity. Okay, equity plus non controlling interest plus reserves. Clear?
Clear.
So, this is basically the split. Understood?
Okay. Yeah.
Now, percentage of capital employed represented by the borrowings. This is loan plus preference share capital divided by ordinary share capital, reserves plus non-controlling interest plus loans plus preference share capital. So, this is debt by equity and this is debt by equity plus debt. Understood?
Yeah. Understood.
More often in questions, this is followed.
Okay.
That is percentage of capital employed. You take both.
Okay.
Next is interest cover ratio, ICR. So this is basically measuring how much of the profit that you are making in terms of your finance costs that are due. Understood? So
Mm-hmm.
this is profit before financing and income tax divided by finance cost. Understood?
Understood.
Okay. And if it is more, the better. If it is
Okay.
more, means you have with you the sufficient profit in order to pay the finance cost. If it is less, then you may have a liquidity problem. Understood?
Okay. Understood.
Now, over trading. So, over trading is when a company is expanding its sales revenue, okay, without any plans or without any structure to its long term capital. Understood? So
Mm-hmm.
uh, what are the indications of overtrading? First is inventory increases, okay, and it is more than the proportion to its revenue. Clear?
Okay. Clear.
Next is receivables is increasing and it is more than proportionate to its revenue. Next is cash and liquid assets are declining, putting the business in a liquidity risk. Clear? The
Mm-hmm.
last one is trade payables are rapidly increasing and they are not paid off.
Nahala, can you please go back for like the page, yeah, down? Would
This
you receivables increasing possibly more than the yeah, proportionately to revenue? What does that mean?
That means the
Like, why is this? Is this bad or is
overtrading.
it
It is very
okay?
bad.
Over three. Okay.
It is very
Oh,
bad.
because of course it's like a debt. Like, okay,
Receivables is
it
something
possible.
that is stored for a very long time, right?
Yeah. Okay.
So
Okay.
even
Makes
before
sense.
collecting the receivables, you're doing more and more you're doing more and more credit sales, and the receivables are piling up there.
Mm-hmm. Makes
So it is
sense.
overtrading as
O-
well.
Okay. Fine.
Clear?
Yes. Clear.
Now, investor ratio EPS is something that we have already learned. Next
Mm-hmm.
is PE ratio, that is profit per earnings. Clear? So that
Clear.
is current share price divided by latest EPS. Understood?
Understood.
Okay, next. Dividend yield ratio. This is basically dividend per share divided by current share price. Okay. Dividend
Okay.
cover ratio means how much of the profit could be divided as dividends. So profit after tax divided by the declared dividends. Understood?
Understood.
Now, what are the limitations of financial statement and ratio analysis? First things first, historical cost accounts, right?
Mm-hmm.
So ratios are used for analysis, that you know,
Yeah.
right? And ratio
Yes.
is going to help us make some idea, some summarized idea about the performances of the business, right? So
Mm-hmm.
it is going to help you identify trends and relationship. Understood? But the problem
Understood.
is it is going to ignore what the management do in the future. It is only taking the past accounts, right?
Mm-hmm.
And if it may, it could be easily manipulated with increase or decrease in the values. Clear?
Mm-hmm.
Okay. And this could also be a distorted differences due to the accounting policies used. Clear? That means due to the accounting policy that is being used, some might be more, some might be less. Clear?
Okay, clear.
The greatest example is you have an asset which is depreciated, and over time it is fully depreciated, but the asset is still there uh in your business, right?
Mm-hmm.
So basically, when you value the asset, it is basically zero, but it is still there. It's an example.
Okay,
Clear?
clear.
Now, okay. So for not for profit organization, how do you measure? Okay. So basically, it is measured using value for money basis. So value for money is three E's. Clear? So
Mm-hmm.
what is that? First one, effectiveness. That means whether or not the aim of the business is achieved. Okay. For example, there is a not-for-profit hospital. Okay, that is being opened.
Mm-hmm.
Aim is that maximum number of patients should be relieved of their diseases or their despair, right? In terms of health.
Yeah.
So that success rate is called as the effectiveness. And what is efficiency? Efficiency is being able to make best use of the resources available in the hospital. Clear?
Clear.
Economy means it should be able to run in a way that it is not incurring too much cost that the company is unable to cover. So that means too low cost but high outcome. Understood?
Understood.
Clear? So
Mm-hmm.
since it is different from profit making organization, there is no profitability criteria here. Clear?
Clear.
However, we can also use ROCE to decide whether the funds invested is creating that much returns. Okay? Or the
Mm-hmm.
gearing or the investor ratios in general are something that is least important to these organizations because these uses profit mainly. But not for profit organization is not about profit, it's about satisfaction of the people.
Mm-hmm.
Clear?
Clear.
Okay, now, okay, so the chances are in the question, you could be tested from consolidation along with interpretation. Clear?
Okay, clear.
So one type of question is that consolidated SOPL. Okay. So you
Mm-hmm.
would be given an SOPL, an individual SOPL, and you would be asked to make the combined SOPL and then the compare the ratio that is being computed. Okay. So they would have a computed ratio with them. You have to compute your own, combining those two financials. Okay. And
Mm-hmm.
then you have to compare each ratio. Clear?
Okay. So it's not me who chooses what ratio. They will tell me which
They will,
ratios.
they will. There would be ratios, four or five
Oh,
ratios that you will see in the
okay.
question that we are about to do. Clear?
Okay. Clear.
Okay.
Mm-hmm.
Now, in case of disposal, it is likely that you would be given a depreciation, a full year SOPL. Out of that, you would have to remove at the time of disposal all the subsidiary amounts and then compare the before and after. Understood?
Understood.
So that is basically it. Remember to just go through the limitations, okay? Question could
Okay.
be asked for 4 marks, theory question,
Okay. Okay.
okay? Or you could have just wanted to say, be very sure that you are thorough with all the standards theory.
Mm-hmm.
There could
Okay.
be MCQs, there could be uh, um, defining questions on how
Mm-hmm.
you have reached a certain amount. I think I showed you day before yesterday. I mean, in the last class before the last class, I think.
As I'm solving the Kaplan questions, there are questions that
Yeah.
ask me about theory. So yeah.
Yeah. That's what. So make
Okay.
sure you're very thorough with the theory part.
Okay.
After this, you're on your own. Make sure you're studying everything. I'm just repeating again. If any question that you're attending, the first and foremost thing that you do is you're going to skip right into the requirements and you're going to see what the requirements are about. The first requirement is for gain on disposal. Okay, second one, explain whether or not the disposal of Silva company is likely to constitute a discontinued operations and the correct accounting treatment for this. Okay.
Mm-hmm.
B.
Okay.
C. Calculate the following ratios for Pinardi Group for 2007 and 2006. Gross profit margin, operating profit margin, interest coverage ratio, inventory turnover ratio, days. Clear?
Yeah.
Now, this is the calculation part. See, it is only for 4 marks.
Mm-hmm.
Only for 4 marks for the equations, for the formulas that you calculate. The
Okay.
higher end is for the 11 marks is for interpretation. That is what conclusion you arrive from the formulas that you have calculated. Understood?
Understood.
So D is analyze the performance and position for Pinardi Group for the year ended 31st December 2007. Compare it to the 31st December 2006. Understood?
Mm-hmm. Understood.
Okay, let's see. Okay, so Pinardi Group operates in fragrance cosmetics industry. On 1st January 2007, Pinardi disposed of one of its subsidiaries, okay, Silva
Mm-hmm.
Company, for cash of how much? 42 million. So we've already got that particular amount. You're going to fill in it. Clear? 42,000.
Okay. Clear.
Remember, always write figures, it's pressed in.
Thousands.
Figures are expressed in thousands. Okay, I'm not writing this, but
Mm-hmm.
make sure you do write in your exam.
Okay.
Silva Company manufactures jewelry and was sold because Pinardi Groups wanted to exit this particular sector. Extracts from the consolidated financial statements of Pinardi Group for the years ended 31st December 2006 and 2007 is as follows. So this was disposed in January 2007. So most likely this particular amount is inclusive of the amount that was from uh, Silva Company. Clear?
Mm-hmm. Clear.
Prior to the disposal, Silva Company used to occupy some property belonging to Pinardi Group. Following the disposal, the Pinardi Group moved its cosmetic division into this property. Previously, the cosmetic division had leased external facilities for 2.5 million a year. Okay. So
Okay.
prior to this particular disposal, it was used by Silva Company, and hence Pinardi Company had to lease a certain place in order to meet their cosmetic division requirements. Clear?
Clear.
So at 1st January 2007, the lease had 10 years remaining. To exit the lease, Pinardi Group made one-off payment of 3 million to the lessor and recorded as the operating expenses. Pinardi Group acquires raw materials from overseas In 2006, the group recorded foreign exchange gain of 3 million, and in 2007, group made a foreign exchange loss of 1 million. Both items were recognized within operating expenses. So this is the information that is being given in the question. Clear?
Mm-hmm. Clear.
We didn't read all this. The accounting assistant. Okay. So here they have given you the inventory, the
Mm-hmm.
cash, the non-current liabilities. Okay. The
Okay.
accounting assistant has not accounted for Silva Company as a discontinued operation because the disposal occurred on 1st January 2007. No figures from Silva Company have been included in 2007 financial statement extract above. That is what I told. The proceeds from the disposal have been recorded in cash and with all net asset and goodwill derecognized. The balancing figure was held in suspense account. Pinadi Company acquired 100% of Silva Company on 1st January 2001. The goodwill was calculated as at that time of 6 million. The goodwill has been impaired by 30% in 2005. The net asset at 1st January 2007 were 35 million. So they have already given you net asset at disposal, right?
Mm-hmm. Yes.
So this particular calculation, no, not needed.
Okay.
Okay, because they have already given you.
Okay.
Net asset at DOD is already given here, which is 35 million. Understood?
Understood.
So minus 35,000. Remaining is, what do we need? We have sales proceeds. We need to have NCI at DOD and goodwill at DOD. Clear?
Mm-hmm.
Goodwill could be easily calculated from here. It is, where is the goodwill?
I think you no, never mind.
Wait. We need to skip all this because they have already given you goodwill at DOA. Understood? And that is 6 million. Clear?
Okay.
Okay, to that we are just
Okay.
going to make the impairment. That is equal to minus of 6,000 into how much percentage was it?
30.
30 percentage. Okay.
Mm-hmm.
So together it is going to be 4,200. So this is equal to minus of this one. Now the remaining amount is NCA at DOD. Since it is an 100% acquisition, there is no NCI. Clear?
Mm-hmm. Clear.
Understood?
Yes, understood.
So the gain on disposal is 2,800.
800. Mm-hmm.
How much mark is it for?
I think it's 2 marks. Yeah.
2 marks. 2 into 1.8. You need to spend exactly 3 to 4 minutes on this one. Okay?
Okay.
Don't take too long. Since I'm explaining, I might take long, but make sure you complete it within that time range.
Okay.
Understood?
Mm-hmm.
Per mark, it should be only 1.8 minutes. Clear?
Clear.
Okay?
Mm-hmm.
Now, next question is on the explanation. Explain whether or not the disposal of Silva Company is likely to constitute a discontinued operation and correct the accounting treatment for this. Okay?
Mm-hmm.
So, this is a subsidiary that to 100 percentage, right?
Yeah.
So, this would meet the criteria of it being a major line of operation. Understood? This is
Understood.
IFRS 5 NCA held for sale, discontinued operations that I'm talking about. This
Mm-hmm.
class has been already over. I'm just
Yes.
saying with words. In the exam, make use of your own words. But this particular line should be there. Separate line of major operation. Clear? A separate
Clear.
major line of operation. This particular word must be there because it's the
Okay.
criteria that means. Clear?
Okay. Clear.
Okay. So if the discontinued operations amounts are removed, then it is necessary that it should be separately disclosed in the bottom of the statement of profit and loss. Okay.
Okay.
And there we are going to take the separate line of all the gain or loss that has arrived from the discontinued operations. Clear?
Clear.
Okay. Now, this particular Silva company was sold on which date? 1st January
First.
2007, right?
Mm-hmm.
Okay. So as of this year, there is no such data available because there is no year passed in order to show the SOPL, right?
Mm-hmm.
Because you prepare at 31st December 2007, your FS. Correct. Am I right?
Yes. Yes.
But in this 1 year, Silva company is not there.
Mm-hmm.
So that is a glitch, right? Even if
Yeah.
it is like that, you have to take previous year figures and take it into the accounts. Clear, no? Into the FS. Understood?
Can you just please repeat the last sentence you said?
As in, this particular business is sold on 1st January 2007, right?
Mm-hmm. Yeah.
When do you prepare your financials? On 31st
31st
December
December.
2007.
Mm-hmm.
But you have sold a major line of business. So this is a discontinued operation section,
Mm-hmm.
right?
Yes.
So the thing that you can do is you're going to take a comparative figure from the previous year financials and you're going to show them comparatively what has happened.
Okay.
Understood? That's all.
Yeah, understood. Okay.
Okay, right?
Mm-hmm.
Now, mm, as part of the sales agreement, Pinadi Group will receive an annual fee of 2 million for the use of Silva Company brand. Okay.
Mm-hmm.
The 2007 annual fee has been included in Pinadi Company's revenue for the year ended 31st December 2007. Results obtained from Silva Company's individual published efforts show the following key information. Okay.
Mm-hmm.
So tell me, no, I'll read the fifth one as well. Prior to disposal, Silva Company used to occupy, that is already read, right?
Yeah.
Now, I want you to calculate these four ratios from 2007 and 2006.
Okay.
I'll give you half an hour. Oh, it was on mute and I have been
Oh,
saying.
okay.
Okay. So they have given you the 2006 figure of Pinadi Group, right?
Mm-hmm.
And the 2007 as well. They've also given you the 36,000 of Silva Company as well. Understood?
Understood.
Okay. So this means if you're going to deduct 36,000 from 122,400, 122,400 minus 36,000. How much do you get? 86,400. Is it?
Mm-hmm. Yes.
Out of the 120
86,100, yeah.
100, it
Yeah.
is when the particular amount is being deducted, it gives you 86,400. Now
Mm-hmm.
9,300 minus 86,400 would give you an increase in 11,900.
100, yeah. Mm-hmm.
Keep that thing in your mind. Okay.
Okay.
In terms of removal, okay, purely by speaking the amount that is being given here, 98,300, there is 24,100,000 difference in the revenue, right?
Mm-hmm.
And this particular difference is why? Because there has been a disposal. Clear?
Clear.
Understood?
Understood.
Okay. And this disposal revenue is, or that means this decrease or the fall in revenue is due to the fact that the 2006 figure included the results of Silva Company's shares, right?
Mm-hmm.
Okay. Whereas in 2007, what happened? The revenue had no involvement of Silva Company's revenue in it. Understood? The Pinardi Group revenue.
Makes
You know?
sense.
And it is clearly given here. In the previous year, it is 36 million. We're just completing a story that is being given you in the question. That's all.
Mm-hmm. Okay.
Okay.
Mm-hmm.
So there was 36 million in the last year. So if you're going to remove this, okay, the true revenue that has been increased for Pinardi Group would be 11.9 million. Understood? That's what we just calculated.
Understood.
Okay. From the
Yeah.
fragrance and cosmetic divisions. Clear?
Mm-hmm.
Understood? No?
Yeah, understood.
Okay. Now, the gross profit margin. Okay. So in 2006, I'm just stating the amounts given here. Okay. To be very exact, I'll take you got the same ratios, right?
Yes.
The same answer.
Okay, for the first one, I got 0.52. Second one, 17.24.
This one. See, can you see
Yeah.
the answer?
Oh, I didn't multiply by 100.
You have to
Mm,
multiply by
yeah, okay.
in order to make it percentage.
Okay.
Clear?
So yeah,
Uh,
52%. I rounded it, it's fine.
yeah, it's okay.
Or
But
okay.
always take two decimal places if you can.
Okay.
Okay. So this
Okay.
is this much, this is this much. So from 2006 to 2007, it actually increased, right?
Mm-hmm.
But
Yes.
there is a catch. Let's see. So here, where is it? Okay. So the gross profit margin is up by, up, has went significantly up, right? From
Mm-hmm.
2006 to 2007, from 41 percentage to 52 percentage, right?
Right.
Okay. Now, when you take the gross profit margin of Silva Company, only Silva Company, that is from down here, that is this one divided by this one, right?
Mm-hmm.
It is how much? 35 percentage. Okay,
Okay.
understood. So from Silva Company alone, it was 35 percentage. So that means Pinardi companies, other group companies were able to generate a profit which was very good. Clear?
Mm-hmm.
Okay,
Okay.
understood? Now,
Yes.
after removing those figures, it is noted that the operating profit margin has increased, right?
Mm-hmm.
Even after removing this particular amount, the profit is still at what percentage? 41 percentage, right?
Yes.
So that means the growth is still there. Understood?
Mm-hmm.
But Why is it due to? Due to the fact that, okay, if you look into it, compare the operating expenses.
Mm-hmm.
Okay, that is, it was 37,400 before, it is
Mm-hmm.
33,700 now, right?
Yes.
So this is just a slight decrease of 3.7 million, right?
Mm-hmm.
Okay, despite the fact that there has been a major increase in the revenue, the decrease in operating expenses is only by this much, right?
Mm-hmm.
And this could be mainly due to the exit fee that has been paid off of the contract. Understood?
Okay, understood.
Okay, understood.
Yes.
Okay. Now the problem is whether or not this is beneficial. So this is always a cost and benefit analysis, right? So if the
Okay.
lease continues, they have to give the 25 million over 10 years. So 25 million is going to go out of the company.
Mm-hmm.
And if you add time value of money to it, it is going to be much more greater than that, right?
Mm-hmm.
So instead of going that much or spending that much, a 3 million exit fee is the plausible option. Understood? So you're
Understood.
going to explain it that there.
Okay.
Understood?
Yes.
Even though they needn't pay lease amount, what happened was in order to exit those lease, they had to pay an exit fee, a penalty. Clear.
Mm-hmm.
But
Clear.
still, that penalty is much more beneficial or profitable to them than paying 25 million over 10 years. Understood?
Makes sense. Okay.
So, this particular thing that I said, I would be writing the same in my exam paper. I'm not going to write as these things are. I'm going to
Mm-hmm.
write what
Mm-hmm.
I understood out of it. Understood?
Understood.
So
Okay.
it is not necessary that you have to write the same exact wordings that is being given you as an answer. Okay?
Okay.
So
Okay.
whatever you understand, you blurt it out. That's what it is.
Okay.
For
Okay.
interpretation, your understanding and your language of command is very important. Clear?
Clear.
Okay? Now, they've also told you, okay, there has been a foreign exchange amount that is being added here, right?
Mm-hmm.
So in 2006, the foreign exchange gain is 3 million. In 2007, it is a loss of 1 million. Understood?
Understood.
Clear? So
Clear.
that is also there. So in addition to this, the foreign exchange gains and losses are included in the operating expenses line, right?
Mm-hmm.
Okay, so in 2006, it was a gain, but in 2007, it is a loss of 1 million. Okay, which
Mm-hmm.
further would have reduced the operating profit margin. Understood?
Understood.
Okay, so that means, see, before it was 3 million gain, now it is 1 million loss, right?
Mm-hmm.
So this would mean that Pinati company is constantly facing foreign exchange problems, right? Foreign exchange risk.
Mm-hmm.
Yeah.
Clear.
Okay. Now, I forgot to tell you something. See, up until this particular place, it is a profitability ratio.
Mm-hmm.
After this, it is in terms of SOFP. Understood?
Mm-hmm.
So
Yes.
ratios are
Understood.
often divided into those two categories. Okay. So
Mm-hmm.
this is the performance part that we are discussing now. Okay.
Okay.
And then after that, we'll go on to the SOFP.
Okay.
Okay. Now, now, the interest coverage ratio. So interest coverage ratio has been good. That is from 2.5, it reached to 5.3 million, right?
Mm-hmm.
Now, interest coverage ratio is due to the fact that the finance cost has been lowered and operating profit margin has increased, right? So that
Yes.
means the numerator is greater than the denominator, basic maths. Clear?
Mm-hmm. Clear.
And this is because you're no more paying interest on lease. It's that implicit interest that you're showing in the FS, it is no more because the lease is out of your hands now, right?
Mm-hmm.
So
Mm-hmm.
this might have contributed to the interest coverage ratio in being increased. Clear?
Clear.
Okay. Now we're going to come on to the SOFP part. Okay.
Okay.
Now, if you look into this is the SOFP, right? See the
Mm-hmm.
non-current liability. What happened to non-current liability? It has majorly decreased, right?
Yes. Mm-hmm.
And why has it decreased? Because
Because they disposed.
they have quit the lease liability, right?
Mm-hmm.
So that means no more non-current liability out of the lease. Clear?
Clear.
Okay.
Mm-hmm.
And the chances are there could be that some non-current liabilities would also have been paid off. Clear. So that is why it is more. It is less. It is
Yes.
proportionately more
Less.
in decreasing. Clear?
Mm-hmm. Clear.
Okay. Now, Silva company was sold for 42 million, right?
Mm-hmm.
Okay. But the major thing to note is that the cash has just increased proportionately less, right?
Yes.
See, it was sold for how much? 42 million. But has the 42 million increased? No. So that means Pinardi company has used particular amount to pay off their debts. Understood?
Understood.
Okay. So that
Mm-hmm.
is why a proportionately high decrease in non-current liability as compared to the removing the lease liability from the SOFP. Clear?
Clear.
Okay.
Mm-hmm.
Now, it should be noted that in 2006, it is a combination of Silva Company and Pinardi Group, right?
Mm-hmm.
Okay. So that means the third chance is also that in this particular amount, there could be amounts of Silva Company, that is amounts of non-current liability that the Silva Company owes, right?
Mm-hmm.
So when removed, it became much more lower. Okay.
Okay.
Understood.
Understood.
Okay. Now, the inventory turnover figures, how much is it? So it is 102 now. It was 114 before, right?
Yes.
Okay. So
Mm-hmm.
this indicates that compared to the previous year when it was with Silva Company, Pinardi Group is more able to increase their inventory turnover days, right?
Mm-hmm.
Okay.
Okay.
So this is also the fact that, okay, Pinardi companies, whatever the products that Pinardi company is producing, it is not perishable, right? What are they producing? Fragrance, right?
Mm-hmm.
Is it something that is going to be bad after 2 days or 3 days? No.
No. No. Mm-hmm.
Okay. So even if the inventory holding period is high, it is not a problem. Understood?
Mm-hmm. Understood.
This means that it is actually corresponding to the revenue. We can say that,
Okay.
right?
Mm-hmm.
Because the inventory turnover is getting low, that means the inventory is being turned out to sales, right?
Right.
Okay. So in 2006, Pinardi Group inventory turnover period included the figures of Silva Company, hence higher. Okay. So removal has shown that the inventory turnover period is lower in relation to the jewelry sector. That's all. Clear?
Clear.
So the conclusion is that Silva Company does generate profit, but it is also good that Pinardi Company disposed of Silva Company. Okay. Understood.
Mm-hmm.
Okay.
Okay.
And you can see that we're going to go down, go to the question and see Silva separately. And Silva Company is also thriving, right? Maybe not as
Yes.
good as Pinardi, but they are also doing good. So that means they are good on their own as well. Understood?
Understood.
So that is also one conclusion that you could make.
Okay.
Okay.
Mm-hmm.
So additional focus is that all the divisions of the Pinardi company has been able to make more profits. Okay. Now every the property that was there used by Silva company is now being used for Pinardi Group itself, right? So they are going to save more on the cost again and lead to increase in profits in the longer run. Understood?
Understood.
So these much is needed. What are the other comments that the candidates gave and the examiner liked is listed here below.
Okay.
Okay, so 2 million now relating to C. Now, after the disposal, you must understand Pinardi company is going to have a 2 million more revenue. Understood? Every year.
Mm-hmm.
Okay. So
Yes.
every year the increase would be even more because it would have a net effect as well. That
Mm-hmm.
means less of that is less of lease
Please,
payment
yeah.
and more of revenue that is going to generate due to the fact that Silva company has to give some sort of fees to Pinardi Group. Clear?
Clear.
Okay. Now this particular 2 million increase, okay, is without having the cost of sales, right? It is just like free item.
Mm-hmm.
Understood?
Understood.
That means there is no cost of sales involved. Even after that, despite that, they are getting 2 million increase in the revenue. Understood?
Understood.
Okay.
Mm-hmm.
So even if 2 million is reduced, it would still generate a profit of 51 something, 51 percentage.
Okay.
Yeah.
Clear.
Okay. Now the cash is only increased by 17 million despite the 42 million sale. And it is due to the fact that amount of cash is in the bank and also Silva company's cash was also removed from the combined thing, right?
Mm-hmm.
So it
Mm-hmm.
created a bigger impact. Understood?
Understood.
Okay. Now, the
Mm-hmm.
exclusion of 36 million revenue and 6.6 million operating expenses of Silva Company from the continuing operations consolidated statement of profit loss for 2006 suggests operating expense as a percentage of revenue in 2006 were 30, 3,800. That is out of the 37,400, you remove 6,000. It is just that operating expenses are measured in percentage. That's all.
Okay. Fine.
Okay, that is the
Mm-hmm.
change in value. That's all.
Okay.
Okay, that is 2006 by 2007. That's all. Okay, now
Mm-hmm.
when you are in the examination hall, make sure which is not there and telling you something which is not here.
Okay.
Here they have given certain figures, right?
Mm-hmm.
Make sure you are taking a percentage of these in brackets as well. Okay,
Okay. Fine.
so 24.1 million divided by that year's revenue.
Okay.
In order to say this much has decreased or this much is increased. Clear?
Okay. Clear.
Hmm? Understood?
Yes. Understood. Mm.
So that's all. Okay, this is how the question is going to be in the exam.
Okay.
Okay, most probably.